I don't know about you, but if you've been comparing mortgage rates lately, they come down a little bit, they go up a little bit, they come down a little bit, they go up a little bit. And Phyllis and John in Alpharetta say mortgage rates have been all over the place. I would challenge that just a little bit to say they've been bouncing up and down, but they've stayed consistently higher than we have experienced over, from 2009, all the way to 2022, basically, because interest rates were probably lower than the average. And if you said, what is the average interest rate in the U.S. over the last 50 years? I think it's somewhere around 6%, and we're just a little bit higher than that, 6.5, 6.75 today, but it seems like a big interest rate compared to the 3% or 3.5%. The last loan I had on my primary residence that I was in for 27 years was 3.375%. That's a very, very low rate. So Phyllis and John want to know, what can they do to understand what's going to happen with mortgage rates? And all I can tell you, Phyllis and John, is to get a good mortgage lender. If you don't have any good mortgage lenders, you can call us or go to gogaddisradio.com and we'll hook you up with a good lender. And they can tell you, they can help project for you what's going to happen with interest rates. But the truth is that nobody really knows, because the interest rate on a 30-year mortgage is typically at a specific premium over the yield on the 10-year Treasury bond. So the last time, and let's just say that this yield is 2%. At one time it was probably like 2.5%. At one time it was more like 1.5 or 1.75%. Let's just call it 2%. Then if you looked at the 10-year Treasury yield and it said 4.61%, then the interest rate on a 30-year mortgage might be 2 percentage points higher than that, because they're charging a premium of 2% over that rate. And you say, what do you mean charging a premium? I'll explain that in a second. So you would expect to see a mortgage rate if it was 4.61, you'd expect to see one around 6.61, which is in the neighborhood of where we are today. So if you want to understand what's going to happen with mortgage rates, understand what's happening with the yield on the 10-year Treasury bond. And the reason those two go hand in hand is because the safest investment in the world is U.S. Treasury bonds, and the next safest investment in the world by institutional investors is mortgage-backed securities. So if they're not investing in a mortgage-backed security, they'll invest in Treasury bonds. They'll only move out of Treasury bonds and into mortgage-backed securities because they're not quite as safe, because they're not guaranteed by the U.S. government, although that's what happened before. They want an interest rate premium.